Hey YouTube, Matthew Decker here, Leveraged Wealth Management. I hope that you're doing well today and welcome to Almost Summer. So today I wanted to do something a little bit different and quite a bit shorter than my normal video because I've had several questions over the last couple weeks about 7-pay premium and MEC limits. And so what I want to do today is I've just got three really easy, really quick examples where I want to go through the exact same policy, but I want to show you the flexibility in the 7-pay premium and how you can change or adapt or adjust your premium levels up or down and what the actual limits are. Because a lot of times when we look at these index universal life insurance policies, the limits aren't all that intuitive because you have to understand how the 7-pay premium works in order to understand the limits. So I'm going to share my screen and we're just going to go through a really quick, really simple level pay policy. So what we've got here is a $2.4 million death benefit, and we've got a $100,000 premium for 15 years. Pretty standard, straightforward design here. And so on this particular policy, the 7-pay premium is $101,000. So out of the box, it would look like this policy has a $100,000 limit in terms of how much you can put in every single year. And that is true to an extent. The 7-pay premium being 101 means that, let's just round and say that it's 100 just to make this easy. Let's say that the 7-pay premium is $100,000. What that 7-pay premium is actually telling you is if you take your $100,000 7-pay premium, you multiply that $100,000 by the year of your policy or what year you're in of your policy day, and that's the maximum premium that you can have paid up until that point. So let me say that a little bit differently because that was kind of bumpy. If your 7-pay premium is $100,000, whatever year of your contract that you're in, let's say you're 4 years into your contract, you have a $100,000 7-pay premium, you take $100,000 multiplied by 4 years, that means in total you can't have paid more than $400,000. Okay, so that's the real 7-pay limit. So what that means is there are implications in how you can actually structure this policy. So I want to show you what I would consider to be like a staggered 7-pay design. And so this is the exact same policy. We've got the same starting death benefit. We have the same MEC limits. We paid $100,000 inside that first year. But then what we did is for the next couple years, we dropped our payment down to $25,000. So $25,000 for 2 years, years 2 and 3. Okay, so if we go back to that 7-pay premium, basically methodology, if we have a $100,000 7-pay premium and we're in year 3, that means we can have paid a total of $300,000 into the contract. Well, it just so happens that in this particular design, we've paid $100, $25, $150. We've paid half of the total premium that we could have paid into this policy. And what that means is we have unused 7-pay premiums. And so what we've done is we've taken the additional $150,000 from years 2 and 3 that we could have paid into this contract, $75,000 a year, $150,000 in total. And if you remember, $100,000 7-pay, let's say we're 4 years into the contract, that means we can pay in total $400,000 into the contract through 4 years. And so we've done just that. We actually rolled over our unused 7-pay premium into this policy year 4. So even though our 7-pay premium is $100,000, we've actually paid more than that in year 4. We put in $250,000. And the reason that we could do that is because we had leftover unused 7-pay premium. So we've still paid a total of $400,000 into this contract in 4 years. We just did it a little bit differently. We've got $100,000 in year 1, $25,000 in year 2, $25,000 in year 3. So that's $150,000 plus 50 and 2. We got $400,000 in total in the contract through 4 years. And then we continue to pay that $100,000 a year. So this is the exact same policy. The only difference is we're flexible with how we paid premiums. Now we can take this even further because we can delay 7-pay premiums to a point where we almost eclipse what's called the Guideline annual premium. So I want to show you that as well. So this policy here, again, it's the exact same policy. The only difference is we've delayed those premiums even longer. So $25,000 for years 2 through 5. And then we gross up the policy in year 6 to the maximum allowable premium. So these 4 years here, we've paid in $100,000, and then we've got $100,000 in year 1. So in year 5, we've got $200,000 in total paid into this contract. In year 6, we know that our total premiums that we can have paid through 6 years is $600,000. And so we gross it up with a $400,000 premium. Now, what's really interesting is the Guideline single on this particular policy is just over $400,000. So we're getting really close to that Guideline single premium by delaying our 7 premium. Now, why are we talking about this? Why does this matter? Well, there's not tons of strategy in delaying paying this 7 pay premium. In fact, if we went back and we looked at our total cash value here in the 15th year, well, I guess we could do that. So our level pay premium policy has $2.2 million in cash here in the 15th year. Our next option has $2.1 million in cash in the 15th year. And the longer that we delay it, $2 million, just under $2.1 million. So the level pay is actually working out better from a cash standpoint. I just think it's interesting that a lot of people get into these policies and they think that they're locked into a particular premium, or they don't quite understand the flexibility that they have within those 7 pay numbers. And so I wanted to highlight that for you here. You do have quite a bit of flexibility in terms of how you pay premiums into these contracts. And if you don't quite get all the way up to your 7 pay premium, that unused 7 pay does roll over every single year. It continues to roll over. And so when you're thinking about your index life insurance policy and how you want to fund this policy, what you really need to be looking at is what is the 7 pay premium. And when you're looking at a specific year, so let's say that you're looking at year 7, if you have a $100,000 7 pay premium, you multiply that by 7 years. What that means is you can't have paid more than $700,000 by that 7th year. And that's how the 7 pay works. Now, obviously, there's other numbers that are involved. There's the Guideline annual premium. There's the Guideline single premium. So those do play a factor as well. But I just wanted to highlight for you here the flexibility of that 7 pay premium. So hopefully that's been helpful. Let me know if you have any particular questions or specific questions about the 7 pay, how it relates to your minimum premium, your maximum premium, the Guideline annual premium. And as always, drop those comments below. If you haven't already done so, subscribe to this channel. That way you can stay up to date on all the future content that we put out on Index Universal Life and cash value life insurance specifically. Until next time, take care.